My name's Dave DeBow, founder of MoneyPartnerFormula.com, and this show is built for everyday real estate investors who are actively doing deals and looking to scale using other people's money. So if you're an active real estate investor and you want to get featured on this show to talk about your own real estate and capital raising experiences, then just go to daveinterviewsyou.com. Now let's get rolling with this episode, and remember to subscribe for daily interview content. Hey gang, welcome back. Today, zooming in from Cincinnati, Ohio, we have a very experienced real estate syndicator, Eric Burns. And Eric has got a lot of experience working in and investing in a variety of different asset classes. And as we all know, things have been up, down, sideways, and all around over the last few years. So I'm really looking forward to talking with Eric about what his focus is on these days and why. So Eric, welcome to the show. Great to have you.
Hey, Dave, great to be on. Thank you very much. So, you were kind of wondering about the asset classes, right?
Well, first things first, give us a little snapshot of what does your current portfolio look like as of early days 2025? What kind of deals are you currently involved in? What's still on the go for you?
Okay, great. So 2024 was really slow volume. And I think that was across the board for everyone. We were really excited. I'm looking forward to 2025 because I know I've been talking to a number of operators in different markets, and they're sensing that their deal flow will be increasing. Maybe not a ton, but anything's better than we had in 2024.
Yeah.
So I was actually really excited to get my first deal in of the year, which was a 71 unit in Phoenix. We closed that in February. So to kick off the year right. And I'm pretty much looking forward to 2025 moving forward, especially multifamily.
So over the last few years, what kind of different asset classes have you invested in, Eric?
So multifamily still remains my bread and butter. And the reason is because it fits my skill set better in a lot of ways. I have a lot of partners that I like to work with in the multifamily space and a couple other asset classes, but they to have access to some really great markets is a benefit. But also coming from residential, I started in with just a turnkey, student rental housing with predictable vacancy. Then I moved into renovating duplexes, and so moving into multifamily was really a leap in asset classes for me because it was a lot larger scale than my duplexes that I was renovating. But to have the benefit of not only being passive, but being scalable and having the barriers of entry removed were really appealing to me. And so after coming off 2024 with this low transaction volume, and it has frankly been harder to raise capital for deals. People are market sentiment is down, rightfully so in a lot of cases. So it was time. It's time kind of for me. I had to reevaluate the last number of months and say, okay, let's stick to the bread and butter. And my skill set really plays better to that because it's just kind of a more intuitive underwriting process because it's just a giant duplex, really, for the most part. When it all comes down to it, the numbers.
You boil it right down to the nuts and bolts. Yeah, really, it's a few more units in there, but it's multiple units under one roof.
5 by 50 or whatever. And
Hey, well, let's back up for a second, Eric. So maybe give people, I know your company, I believe it's called Flowers Capital, if I'm not mistaken.
Yep.
So what role do you play primarily in the deals that you're involved in? Are you a co-GP on these projects? If so, are you more on the capital raising side, the operations side, the acquisition side, the management side? Where's your sweet spot, Eric?
My sweet spot is absolutely in capital raising.
Nice.
And a lot of times I'm now not looking at GP opportunities as much. And the reason being is there's a model out there that's becoming more popular by the year. And it's a SEC vehicle that's a special purpose vehicle, or what they would call a fund of funds. So there's regulations surrounding that where I can raise money for a deal, and the fund can invest without having to take an active role. And it's nice on both ends because for the operators, I get to help finance their deals, but it also helps them to remain more compliant. So you start getting into 5 operating partners, 5 GPs, and things get a little sticky for both the general partnership, and it just gets confusing for the limited partners. So being able to invest using that vehicle is really nice for both parties and the passive investors to help their compliance as well. And it also helps because I don't have to take an active role and prove I have an active role and
Do
really
all that, jump through all those hoops and be considered.
absolutely, yeah. So the SEC gets pleased and
So if I understand this correctly, Eric, basically the way it works is you've got a fund and you bring investors in, you raise capital for your fund, but that fund can invest as a kind of like an LP in different projects, and then you're able to, instead of just investing 50,000 or 100,000, because you've got a fund, you're maybe able to invest $1 million or more in a particular project, get beneficial higher returns, more equity, that sort of thing, and then you kind of figure out how to divvy things up with your investors on the other end. Am I understanding the
yes.
general
So the
idea?
fund invests in as an LLC, which is also regulated by. So when they invest, it's as an LLC. So when we bring, say, $500,000 to a deal, we might have 10 investors if at $50,000, but we come in at 50,000, 500,000, and we're able to take advantage of the better preferred classes of shares.
Mm-hmm.
So the splits are better, the prefs are going to be better, and so that passes through the limited investors. And it actually the economics generally work out better for them because they can have the better asset share classes, and they're going to get better prefs and things like that too.
Very good. So lots of pros to that. What are some of the not so great sides of things of doing a fund to fund in your experience, Eric? Or what are some of the complications, perhaps?
Without being on the general partnership, there is a sense of feeling like you're not necessarily in control of the deal, but at the same time, I also know I'm working with better operators than I
Mm.
was an operator. So, and a great way, and that
Yeah.
is honestly why I niched down to capital raising exclusively, was because when I first went into commercial, I started sourcing general partnerships for myself. It was really hard to find. And then I look around in my network, and a lot of it was from masterminds or events where I organically connected with a lot of sponsors and operators. And I look around and I go, wait, they're wanting me to help raise money for deals. Their deals are better because they're getting better looks, they're getting better financing, and their operations are much tighter, and they're just better at this than me. Why not leverage their expertise? Why
Yeah.
not let them play to their strengths? And I really enjoy the content writing, the education, and the marketing aspects of capital raising as well. So there's a lot of reasons why that plays better to my skill set,
Mhm.
and same as investing as a limited partner. To me, it's better. It's more beneficial to anybody I bring in a deal to leave it to the actual pros that have done that. That is a more rinse and repeat for them.
Yeah, really, really smart. It's all about knowing where your strengths are and focusing on that, and not trying to, get better at the things that you're naturally good at instead of trying to get better at crap that doesn't really interest you that much.
Absolutely.
Yeah.
And I'm taking advantage and we get to help each other. So
Yeah.
I get the advantage of their existing relationships that have taken them 10 years to build up in these really great markets. That's why they're getting off market deals, and that's why brokers are calling them, because of these existing relationships, because they can close deals. Where for me, broker relationships are a lot harder. And
Yeah.
I might be getting a second or third look, and so it's been through the ringer a couple times. So it makes it harder for me to even get one under contract.
Yeah, that's really smart, Eric. So, well, let me ask you this from a capital raising side of things. Is it more complicated to raise capital for a fund if you don't have the deals kind of lined up ready to go and you're just trying to explain to people how the fund works? Or do you or is that simpler than trying to raise for a specific deal? Or how do you do it?
I prefer to raise money for a deal before I have a deal.
Yeah.
And that gives me a chance, whether it's a 506B, which requires a cooling off period and a getting to know you type of period, and a 506C, which can take accredited investors without that. It's still beneficial to everyone, myself included, to have a pre-existing relationship and understand what my investor's about and understand what kind of deals they will be looking for and what's going to fit their profile. And then when I do have a deal, I know I can take it out there and say, hey, remember we had talked about something like this. You kind of know what I'm about already. What's the deal look like? So And I usually get a few months before closing to know what I'll be raising for, and
Okay.
after that, and I can kind of know what to expect just by keeping in touch with my operators as well. So I know when a deal might be coming, that sort
So,
of.
so do you get your investors to invest in the fund already, put their money in kind of sight unseen ahead of time, or do you kind of get them lined up, primed up, maybe with a soft commitment or something like that ahead of time, and then when you've got the deal, that's when you get them in the fund?
Absolutely. My fund is always going to be a one-off per investment. So I don't take money into the fund until we're ready to create a special purpose vehicle very specific for that deal. So when I'm out talking to investors, I love getting people on the phone before I have an actual deal. So I can talk about a past deal. I can get an idea what they like. And then from there, I do try to get a soft commit and say, hey, if there's a deal that looks like this, what would your investment sentiment
Smart.
be on that? And
Yeah.
then it's just a matter of really digging into the business plan and saying what do you like, what do you not like about this business plan? Because we're already talked about the what a deal looks like, and we've already talked about the markets, and we can kind of just jump in and say, is this the right one for you or not? You know?
Yeah. Well, that's the smart thing about specializing again in multifamily, because then you don't have to explain a whole different asset class to somebody. You kind of got your case study that you can show a prospective investor on how a quote unquote typical multifamily deal works. And then when you've got a specific one, you can just kind of explain what the specifics are on that deal instead of you know, having to bring them up from scratch on a how self storage works or how car washes work or how industrial works or that sort of thing. Is that fair to
Absolutely.
say?
Any
Yeah.
any alternate asset class or any additional asset class would be something I would prefer to grow into with the investor, and that we've got a couple multifamily deals that we get that under our belt and say, hey, these are kind of the normal, a more normal asset class. You're probably more used to it because it's a lot like buying a house with a down payment type of situation, and then grow into some of these like RV park developments are super
Mhm.
interesting, and new construction is super interesting. But there's also more risk in something like new construction, better returns, but it's also something to say, hey, this is going to be a little more risky, but we've also got a couple good multifamilies going. Is this going to be for you? And kind of just grow into a new asset class with the investor, depending on kind of what they're looking for. Um, a self storage might be a little more recession proof, where a development might give you a lot of back end upside too.
Yeah, definitely. No, that's very, very cool. Smart, Eric. So sounds like capital raising is your gig, man. So what do you a lot of our viewers and listeners are, mom and pop real estate investors wanting to get started with bringing on joint venture partners or raising a little bit of capital. What are some of the things that you have found have worked best for you for connecting with new potential investors? Not just connecting, but eventually converting them into actual investors in your deals.
I prefer truly I prefer LinkedIn.
Yeah.
And the reason is because I'm able to post content and give my followers an idea of kind of what I'm about and some of my backstory. So it's a more organic, a little more natural conversation between us. But it also gives me the chance to be able to kind of DM, and I like the DM feature to say, "Hey, my name's Eric. Thanks for connecting," and then start saying, building a more. It's just an easier way to build a more natural rapport rather than having to rely on a Facebook ad or something like that. So that is 100% my preference.
Nice. More organic using social media. My favorite as well, LinkedIn, because not everybody's posting what they had for lunch
Hmm.
today. It's a
Yeah, the food post, oh, for sure.
it's a little it's a lot more business focused. That's what it's supposed to be all about. Okay, that makes a lot of sense. So it's getting content out there, and I've heard all sorts of schools of thought about this, Eric. But you do this all the time, so I definitely want to listen to you. What kind of frequency do you recommend to people for posting content? And what kind of content have you found kind of creates the most engagement?
So they say that LinkedIn will tell you can get up to 4 times the views if you post once a week. Now, I try to post every day, and I think the general rule of thumb is if you're doing a couple of posts a week, that'll get you a little more traction on the platform. But I try to post 5 days a week out of habit more than
Yeah,
anything.
like a discipline. Yeah.
like a discipline, and I do mix it up. And the most reactions I have on the posts are definitely ones that get into my personal story,
Oh,
and
okay.
truly have a lot less business and real estate in them. And
Interesting.
people seem to like. I get a lot more comments on that, which is super fun. But also, I get a lot of when I do have a deal, I get a lot of views and a lot of comments on that. And it's kind of the other kind of benefit to using LinkedIn and the DM system is even if I don't find an investor out of a connection, I still have a lot of neat connections that make the platform just more fun.
Yeah. Yeah. No, that makes a lot of sense. Eric, well, this has been fascinating. I really appreciate your insights, and I congratulate you on figuring out early on what you liked doing more. And like me, you realized I too suck at being an operator. I don't like dealing with tenants and toilets and all that kind of stuff either. I'd far rather be on the more passive side of the marketing side of things. That excites me as well. So,
Mhm.
yeah, cluing into that and then really focusing on that. I also really appreciate your information about LinkedIn because so many capital raisers, I see them trying a shotgun approach, right? So they're cold calling people, they're out attending events left, right, and center and just schmoozing, handing out business cards without any rhyme or reason. And I'm sure you get around as well, but you really focus most of your energy on what you know works, which is LinkedIn in your case.
Hmm.
Yeah.
Absolutely. And the other thing I would like to add, Dave, before we do sign off on LinkedIn is engage naturally, but also look at other people's posts and make sure you're commenting on those posts.
Hmm.
And again, it makes it more fun and it exposes you to a lot more business ideas and it makes it a lot more fun connecting with people when you know what their content is as well. So
Yeah. No, that's good advice. Awesome, Eric. If people want to connect with you, where's the number one place you would send them?
I do have an article of some mistakes to avoid in your next commercial deal at flowerscapital.com. Just go ahead and click and get that resource.
Awesome, Eric. Thanks for being on the show. It's been a lot of fun.
Been fun, Dave. Thank you.
All right, everybody, take care. We'll see you on the next one. Hey there. I really hope you enjoyed that episode. And as always, if you want to listen to more daily interview content, make sure you subscribe. And if you're an active real estate investor and you're doing deals and you'd like to get featured on this show, then just head over to daveinterviewyou.com. Now, at moneypartnerformula.com, we help real estate investors to create a process for predictably getting capital so they can do more deals without relying on hard money lenders or the banks. We do this by building them a private capital marketing system. Now, if you want help turning yourself into a big money capital attraction machine, then book a call with our team to see how we can help. Just visit moneypartnerformula.com to find out more. All right, take care, and we'll see you on the next interview.